the dealers are as concerned as I am about the viability of their business model, of receiving product. We've had to continue to pay more and more money just to pry any silver out of the market. And so I would say to you that there is a dislocation between the paper price and the real physical price, as much as $6 to $10 an ounce, depending upon where you're buying it.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics, and one of our most popular guests back on the show, Andy Schectman of precious metals dealer Miles Franklin, who's kind enough to give us a couple minutes and an update on what's going on in the physical gold and silver market. So Andy, welcome on in, and how are you today?
Good to see you, Chris. I'm glad to see you're looking well. Glad to be back. I'm well, thank you.
Well, I appreciate that, and I know you've had plenty to do lately, so perhaps just to dig in, on an ounce of silver, premiums really have continued to go up throughout the industry. What are people looking at for an ounce of silver these days?
Most companies in the industry will tell you that the price that you're seeing is not real, that in order to get the real thing, you're going to pay north of 20 bucks an ounce, and in most cases much higher than that, depending upon what kind of silver that you're getting. But the bottom line is that we've had to continue to pay more and more money just to pry any silver out of the market. And so I would say to you that there is a dislocation between the paper price and the real physical price, as much as $6 to $10 an ounce, depending upon where you're buying it.
Okay. And do you see any signs of that abating anytime soon? At least from what I read and the folks that I'm talking to, it doesn't seem as if there's a solution around the corner. Thoughts on that?
Yeah, a lot of people are insinuating that the dealers are charging too much. And I would answer that by simply saying this. This is different than in any time in the past, Chris. And we can go back and look at 2001 or 2008, and you see crises in liquidity primarily, where the Fed could come in and lower interest rates and pump money into the system, and all was well. But my question that I would simply pose to people is, what would it take to get this system back up and running? And if all of a sudden there were a cure tomorrow, then yeah, everyone's paying too much and the dealers are charging too much. But I think the dealers are as concerned as I am about the viability of their business model, of receiving product. Everything is very supply chain dominant in this industry, everything. And if you go all the way down to the very bottom and realize that the mines are out of business, they're shut down, the mints are out of business, they're shut down, the refiners are out of business, they're shut down. So much of the industry is working at a skeleton crew type of a chain. And so if it's very fragile, and if all of a sudden things get worse before they get better, then it doesn't matter what the premiums are, there'll be nothing to get. And so simply speaking, we've had to pay more money to get product. It's harder and harder to get. There are delivery delays everywhere, and everyone is working overtime with a fraction of the people behind the scenes packaging it and getting it at a time when demand is off the charts unlike anything I've ever seen. So I think premiums, if it doesn't get better anytime soon, premiums will go nowhere but higher. I really do believe that.
Well, I could imagine. And Andy, as you're saying that, it reminded me, how about if I take what you just said and raised you today's headline from Ronan Manley, who I had on the show last week, very close to the LBMA. He thought this thing blows up this year, and here we see bullion bank nightmare as LBMA Comex spread blows up again. I believe that was posted this morning. And then if we see over here on the Miles Franklin ticker, the metal's having quite a day today. Gold up 59 bucks, silver up 83 cents, palladium up $104. Wow, look how cheap platinum is at $755 in a world of unending money printing. You talked a little bit before we started the record button about the dislocation between the Comex and the LBMA. So I'm curious, any thoughts on this and how you see that from your perspective?
Yeah, I think it's the beginning of the end for the Western price setting mechanism. When you see dislocation right now by over 20 bucks, if you go to Kitco and look at their price, it'll be over $20 cheaper than what the real price is. You're beginning to see the West being exposed for what it is. And the term rehypothecation comes into mind, and that is when all of the gold bars on the commodity exchange are sold many times over. So as an example, at the April delivery month last week, 28,000 contracts stood for delivery. That's about 5 to 6 times what we normally see stand for delivery. Normally it's 6,000 stand for delivery. And when you talk of 2.8 million ounces of gold standing for delivery, that's way off the charts. And so because of this rehypothecation, Comex was not able to deliver. In fact, they changed the rules midstream. And remember, they only work in 100-ounce bars. They now put a provision in the contract saying if you stand for settlement in a market where most people never do stand for settlement, if you do, you may have to accept fractional interest in a 400-ounce bar. And I can't quite figure out how they plan on doing that. But those bars are in London, and the London Metals Exchange deals in 400-ounce gold bars. So basically what they're saying is, well, we don't have all the gold here, and we may have to get it from London in a 400-ounce gold bar. But London's saying, well, wait a second. Well, we don't like the price that you're quoting. Actually, it's not real. It's below what it will cost you to get the real thing. This is bad, and this is the beginning of mistrust in the price-setting mechanism. And you know, I think that the rest of the world, who, especially the central banks who have been accumulating gold over the past 3-4 years, they don't care that the price is artificially low. At some point, though, however, when there's no bid, when no one will believe the Comex market, very quickly the Comex market will break, and then you'll see prices go to the moon. What is the price then? What is the price availability? And at that point, this whole industry changes from the ability to lock things in on a verbal handshake to everyone having to front wire the money because there's no way for us dealers to hedge our risk. And that's all done on the Comex market. But it is beginning to break. And I had an example about 10 days ago when this first happened. We tried to lock in a $3 million order over 1,750 coins. We agreed on price with the client. When I called to lock it in, I was told gold spot was $40 higher than what I was seeing on Kitco. And how am I supposed to call back a client and tell him that the price that he's seeing is not real? And by the way, it's $40 higher on those 1,750 coins. It's beginning to happen in real time, and it's not getting any better. It did get a little better for a little bit, but here again today, we're seeing a $20, $25 dislocation from the Comex to what London is saying real gold is. And so anyone who's trying to buy real gold right now, I don't care that Kitco is showing it at 1680 or 90. You're paying over 1,700 bucks an ounce spot right now, according to London, in order to secure those things. It's the beginning of the end for the Comex market, in my opinion.
Yeah, Andy, a lot of interesting points you mentioned there, and I'll pull it up real quick before we wrap up. But you do see a price divergence here on investing.com. We see 1746. Whereas Kitco still below 1,700. And what is also interesting, I think a lot of people are seeing about 110-ish to 1 gold to silver ratio. Although if you're actually buying metals, that's in the 70s. So we'll let you run for today, Andy. But just in wrapping up, can you let folks know if they're interested in buying or selling? I know you're paying above spot for metals, which I don't know if that's ever actually happened before, but how can they reach you if they're interested?
So we've always, in normal times, paid over spot. Typically, we guarantee the highest bid price in America, especially if product was bought from us. But the premiums right now over spot are getting really strong. Anyone who wants to reach us, for the last 8 weeks, we have promised we would beat any price in America, and we're continuing to do so. Same thing for your listeners today, Chris, and they can reach us at Arcadia Economics at Miles Franklin, or sorry, just Arcadia at Miles Franklin, pardon me. Arcadia at Miles Franklin, and someone will reply to your email within 24 hours. Be as specific as you can, and we will get right back to you with quotes or answers to your questions. And one last thing, and about the about the Comex. Just give me 5 seconds on that. I believe the next delivery month is June. And if I were a trader, Chris, I'd stand for delivery. If 2,800 contracts stood for delivery and then it was discovered that this was happening, I can only imagine how many traders are going to jump all over that next time. And so within a month, if you told me the Comex breaks once and for all and we see prices higher than anyone can ever imagine, I'd believe it. I really would. I don't know what the future holds, but to me, that's the crack in the dam that is only going to get bigger. So yeah, people can reach us at Arcadia at Miles Franklin. We'll get right back to you. And I really appreciate being on your show, Chris. Have me back anytime, and we'll be happy to let you know what's going on from this end of the world.
Andy, it's a pleasure as always. And folks, if you'd like any more coverage of why so many people are expecting the gold and silver markets to go as they do, then just stay tuned and click on the box.